Hello, welcome back. Been a little while since we last talked about Alibaba. It's one of my favorite companies right now based on their financials and their current stock price. We have made quite a few videos about it, but I wanted to make this one and kind of go through the process of analyzing the stock with our exclusive tool here, because we do have a lot of new added functionality since I last examined the stock, and I wanted to go through again, or go through the financials of the company with you. I think it's going to be very nice, especially since we have the later news about Alibaba. Now, the tool does a lot of things here. In case you're not aware of it and you are new here, you may consider subscribing because at some point in about a couple of months, I will be giving you access to this tool, and you will be the first to know and the first to get access if you're around. And please leave a like as well if you enjoy this type of video. So, the first thing that I always like to examine is taking a look at the news about the company. And so here you will see that the stock news for Alibaba mentions this regulatory game changer, which you may have heard about. And I can open it up here so that we can read a little bit. It's about China and US reaching an agreement about audit inspections. So that's extremely important because this brings down risk. This was one of the bigger risks, really, whether the Alibaba reported values were actually correct or there were some sort of fraud or anything of that sort. And people were not sure whether they were too reliable. Now, if China actually reaches this agreement with the US and they have all these audit inspections and stuff, I'm fairly confident that the stock price will skyrocket. So I wouldn't be surprised if we're going to see a massive increase actually right now, when that happens at least. So if we go back here, we will see in the social trends about the stock something interesting as well. There has been much less discussion about it for the most part. I guess that's because today is Sunday. But as you are actually following this one, you will probably see some spike tomorrow, especially if the stock is gonna be doing well. This is updated every hour pretty much. So right now you would kind of expect this kind of decrease in activity. Although Twitter does have some increased activity from yesterday. Interesting. Okay, the next thing that we're going to take a look at is going to be our stock analysis tool. And using this tool, we will examine what the company is doing financially. We did have this big drop over here, where the company reached 73 at some point, was the lowest, and then started having its climb. Next day it was like 25% up, and it's going better and better. Now, if you go back 5 years, you will see that we are sitting at a on a massive low, really. And the company's IPO back in 2017, no, that's actually 5 years. So the company's IPO was back in 2014, yep. So, yeah, the chart here does goes till 5 years back. This is something that I'm working on. It's going to be more than that, more than 50 years. But the next thing that we want to examine and take a look is the 1 year high, first of all, was $245, which I think is very easily achievable very soon. But the PE ratio of the company is sitting at 29.4, which is probably a little bit more than you would like. However, what I mostly take a look at is the price to free cash flow ratio, and this one is way better. Because it's the free cash flow that is about the cash that the company generates. Both are important, but since price to PE ratio really can be kind of fixated with a lot of different mechanisms, free cash flow is not so easy to forge, legally forge really, and so I prefer to use that. Outstanding shares, there is a little bit of extra shares here being issued from the company, so there was a little bit of dilution. However, you must have heard about the news that the company is actually going to be buying back even more shares than what they originally announced. So this is going to be going down, which is another big plus. Now, the thing that I have added, and it's new to the tool as well, is the free cash flow to total liabilities ratio. And this is an explanation of what it is. It's basically the free cash flow of last year the company made, divided by the total liabilities that the company had last year. And this kind of tells me how many years it will take for the company, if they wanted to, actually repay the total liabilities just by using 1 year's free cash flow, last year's free cash flow. This is a very useful metric because it tells me how much total debt total liabilities the company really has, and whether they can actually serve it very quickly if they really wanted to, just by using the free cash flow. I really like having this this figure here really helps me understand some more things about debt quickly. The 5-year revenue growth is pretty awesome here, same with the net income growth as you all see, and the free cash flow growth. And the very, very nice thing is that these are very similar numbers. I mean, there's not the odd one out where two of these are positive and one of them are negative, because that would point to some artificial things happening with the company's numbers, which are legal but can happen, and we have talked about it in multiple videos. The 5-year total equity growth is another thing that I just added basically. It tells you how much total equity the company had in 2017, for example, 5 years ago, and compares it to today. And so from 5 years ago, the total equity of the company has grown 250%, which is insane. This is awesome growth from 46 billion to 163 billion in total equity. Another very nice metric, because this can actually quickly tell you how clean the balance sheet of the company is, and you can use it with this one to actually deduce some more information about the debt. And this kind of very, very quickly tells you things about the company's balance sheet and actually correlates that to debt. I think it's very useful. And a lot of other metrics here with some that are, normal and expected. Debt to equity ratio is low, not much debt for the company. Current ratio is also relatively good. It's, the higher the better here, because this is current assets divided by the current liabilities. So it means that we have more assets than liabilities for the cash equivalents, that is, and cash. The PEG ratio is the only one that is actually negative here, pointing to potential revenue growth stalling here, maybe. That may be one of the minor concerns. That's not too much of a concern for me, frankly, because if I take a look at the financial statements, which I will do next, you will see here that in terms of revenue, the company has been achieving insane revenue, 40%, 35%, 50, 58. And even if we take a look at the quarterly periods here, yeah, there have been some quarters that were not the best, and this one, for example, was a loss. But this can happen, and this will happen to any company, and no company will be growing forever at this rate. And this company is already making $110 billion almost in revenue, so they cannot be growing 40% a year. That's not going to happen every year. There will be years where the growth will be 5%, 6%, 7%, or even negative in some situations. So that's to be expected. And the net income, again, growing very nicely here. So all the financial metrics of the company are growing tremendously well here. And what we examined earlier about the balance sheet, remember, 46 billion to 163 billion. Pretty much the equity of the company growing very nicely here. And if you take a look at the total liabilities, which is 93 billion here, and you go to the cash flow statement and take a look at the cash flow, which is 28 billion, you will notice what we examined earlier. It would take about 3.5 years of free cash flow to repay all the total liabilities that the company has. And we had this very, very handy formula to tell us that at the beginning of our stock analysis part over here. This was the value that we're talking about. This was the breakdown, 3.26 years pretty much. All right, the next thing that I'm going to be doing, because everything so far looks amazing, of course, all the financials, what I want to do is, of course, use our stock projection here, just stock projections, the stock evaluation tool, in which we're going to be having projections about the future of the company. Now, we do have our handy averages here, the revenue growth, net income margin, and free cash flow margin. You may be asking why we have all this. There's a very, very important reason. Now, revenue growth is about the sales of the company, how much they are selling. Net income is how much profit they are making after all the expenses are deducted. But net income margin is actually how much of the revenue has become net income. So this means that if we made, let's say, $100, 25 of these dollars, 25.37, became profit, were profit for the company. And the free cash flow margin points to how much of this net income turns to free cash flow. And we don't want to see high discrepancies here. There will be some discrepancies for sure, but not very high discrepancies, because if we do see discrepancies, then we know that something is wrong. Something is not expected of the company. There is potential for maybe, if like the free cash flow is elevated, there's a potential for a lot of stock-based compensation, for instance, or a lot of amortization or depreciation, for example. Things of that sort can really, really skew our results. And when we're seeing values that are very similar to each other, this is a very, very green light for us, especially when these values are good, of course. So the revenue is amazing here. We do know that Alibaba's revenue is going to stall a little bit. So I'm going to go with a low of 15, which I think is actually very low, frankly. But still, I'm going to go 15, 20, and let's go 25 for high estimates here. Now, of course, when you get your hands on the tool, you can use your own values for sure. But this is what I think is kind of indicative of what the company's projections could be for the next years, next 5 years. That is, this is a 5-year discounted free cash flow model. If it was a 10-year discounted cash flow model, by the way, you would probably use lower projections here because it's more years on the horizon, and so you cannot really project that well. But 5 years is much more fair, makes more sense. And the net income margin here, again, very, very similar to each other. Love to see that. I'm gonna go 20, 22, 24 in between these values. And the free cash flow margin, again, very, very similar. We did have a year of 90, but it's probably the odd one out, and we should be safe to use 100, 110, and 120 here. And the annual return that I want to be getting is 13%. You can get about 10% just by buying an ETF, an S&P 500 ETF. If you're willing to invest in a single company, you should be making more. You have more risk. So I hit calculate. And when I hit calculate, I get these values here. For my low estimates, the price that I should be willing to pay today, that's today, the max price to pay today, to buy the stock is $202 with these projections. And this is the low projections, actually. This is the low one. And for the medium projections, the price should be at most almost $300 here. And for the high ones over here, which I think are actually very achievable, we're going to be seeing a 428 being the current max price to pay today. And we have 110, so all of these projections are way below. So even our lowest estimates here are actually below our current price, which is 110. So one question to ask actually is, what would it take, what kind of projections would it take for us to get a price that is closer to 110? So we're going to play with the revenue. So let's just say that we'll go 5% revenue instead. And we hit calculate again now. And so low changed and became $134. Even now, we're still in the green. So even if the company makes 5% revenue growth, which is like they make like 10 in a quarter, at least 10 in a quarter. So if they, for the whole year, they make 5%, then even then our max price to pay is $134. What if they make 1%? Let's just say 1% revenue growth. So 1% revenue growth, this is when we're reaching our current price. So basically, if the company doesn't really grow, then we're looking at the current price of the of the stock as is today. So, but the company doesn't grow at all in the next few years. So this really points to a company that is massively undervalued right now, and this is why I love Alibaba, and this is why it's one of my largest holdings personally. And I have bought quite some actually as it was dropping, and yeah, it's doing well right now. I bought at good prices really, even when it went below like 80 or so, 85 I think is the last batch I bought, something of that sort. But yeah, in terms of Alibaba's growth and what they will be doing in the future, I think this current price is a joke, really. I think it's very, very low. And remember, this is the max price to pay today in order to enjoy this kind of potential growth here of the company's revenue growth of 25%, which is for sure a little bit elevated here. Yet it's actually less than any of these, the 5-year average, the 3-year average, and the last year. This is less than all of these averages. So bear that in mind as well. So that's what I wanted to talk about in terms of Alibaba. I think there is a massive upside actually, and especially if the risk about the US and China regulations gets mitigated, then I think we're gonna be seeing massive explosion really in the stock price. I wouldn't be surprised if this risk actually for sure gets mitigated, and there's no fear of a delist. I was never really scared about this, and I mentioned it in multiple videos, but people were. But if this thing dissipates and goes away, then I would be surprised if this doesn't become a multi-bagger in the next 5 years or so. And so for the next 5 years, again, especially after the risks are mitigated, I wouldn't be surprised if people started flocking in back to the stock, and quite easily and fast actually allow for the price to reach much higher levels. And again, I wouldn't be surprised if I see 500 in like 5 to 6 years or so. I wouldn't be surprised at all, frankly. We'll see. But that's what I wanted to talk about in terms of this company. Again, if you're new here, thank you for being around. I hope you enjoyed the video. Please leave a like. That really helps. And subscribe at some point. Again, you will be gaining access to all this. This is a very helpful tool. I have been using it for all of my videos really lately, especially. And I still keep working on it, and I love it. It's really good. So, thank you for watching this video, and I'll see you in the next one. Have an awesome Sunday. Bye-bye.